We get calls from people who just have no idea what's going on in their retirement plan, and they know they have to do something, they know they need a change, but they don't know what to do or where to go, and that's why they're calling us.
I think the main draw is the concern to run out of money, and I think they're looking for some type of answer. You're not taking double-digit losses, you don't need double-digit gains. Is an extra 5% really worth risking your whole retirement on? When you remove the emotions, it's an objective situation. It's not opinionated. Here's the money that you have. Here's what's at risk. Here's your liabilities. Here's the gap. What do we do?
Hey, everybody. Welcome back to the Greenlight Retirement Show. I got our hosts, Tim and Corinne Fitzwilliams and Ron Wright. How are you guys doing?
Doing great. How are you?
Doing great.
Good.
How about you, Ron?
All right.
Doing well here. It's a little stormy here in Miami, so you might hear a little thunder, but other than that, we're doing good.
The storms don't last long there, do they?
No, it's just a nice little reprieve from some of the heat. Little break.
It's getting to be sort of what I call monsoon season here. So it'll rain, but when it rains, it's like you just stepped into the shower.
Mm.
And then 10, 15 minutes later, it'll tail off. So
Gotcha.
Fun stuff.
So it's all just wind and blowing through anyway. And that kind of brings us to some of our current events that we wanted to talk about. There's a lot of news blowing around out there, too. Mm-hmm. There's a lot of back and forth. There's a lot of disagreements these days in the headlines. Confusion. Hopefully we can demystify some of that for all y'all in the next hour or so that we have with you. But, Ron, we wanted to get started. You know, what's going on out there in the market? What are some things that you're paying attention to that everybody else should be paying attention to as well?
Right. Well, the market has been really on a tear. It's been a phenomenal quarter, and which is a surprise to most people because they weren't expecting this kind of thing. We were concerned coming after the first quarter. We were very concerned about back-to-back negative quarters of growth, and instead, the market has really shrugged that off, and businesses have pushed through phenomenally. We've got three back-to-back of double-digit growth, which is really rare. So, just really powering through. Consumers are still buying, and even though all the sentiment surveys are coming in with a lot of concern, people are still out there shopping and doing things. So that's propelling the market forward. We're up at really high levels, and yet still able to continue powering higher. So one of the things the three big factors, two big factors we'll go with, that the marketplace is looking at right now are inflation and employment. And that's really what's on everybody's mind right now. So on the inflation front, the numbers are coming in as expected. Okay. The expectation has been that they would rise up a little bit because of the tariff effect and such, and so that's what we're seeing. But the numbers that the Fed watches are the PCE numbers, the personal consumption expenditure numbers. Yeah. And that's coming in right in the headline number coming in right in mid 2 to 3, so it's about 2.6. And the core number, which strips away the effects of food and energy prices because those are very volatile, the core number comes in at about 2.9%. So below the 3%, but still significantly above the 2% level that the Fed is targeting.
Yeah.
So that's on the inflation side.
Yeah, I was going to say we should talk about the employment side a little bit because with employment starting to get a little shaky, but yet the consumer is really resilient, it seems like maybe the consumer knows something that the unemployment numbers don't. But through all this persistent inflation that we've had over the last couple of years, the resilient consumer, continues to persevere. What's kind of your take on unemployment and the consumer there?
Yeah, well, we were talking before we started recording, and Tim made a great point that employment is a lagging indicator. So by the time you see the bad numbers in the employment reports, it's already too late. What we are seeing is, for instance, today we had the job openings and labor turnover survey, and job openings have continued to decline while the turnover aspect, people that quit their jobs or are laid off, that's been relatively flat. So not a whole lot of change in the separations aspect, but job openings have been declining over the past few months.
Okay.
And that's a good leading indicator of businesses saying, well, we're not ready to let people go, but we're also not going to go out there and hire new staff.
Interesting. So it's not from new hiring, it's from them closing those jobs. So it isn't necessarily somebody upgraded their position because the turnover is relatively flat. It's not necessarily somebody who just moved to a different job for a pay raise per se. It's more of employers just saying, I'm going to take this job off the shelf for now, and we'll, put it back into, supply, if you will.
I look at that as like less top heavy. So generally speaking, as a business owner,
Sure.
you want to be somewhat top heavy so you can take on any acquisition or growth that you have planned in.
Mm-hmm.
Exactly.
And in this situation, when there's uncertainty or you're concerned about something, you can scale back the top heaviness without having to cut jobs themselves already in place and hurt your employees. So this is a way to just say, well, we had these 4 or 5 positions we were thinking about. Why don't we maybe drill that down to like one add-on, and we'll see what next quarter brings, instead of putting out the capital ahead of time to have new employment when you don't think you're going to get the revenue from those employees made back.
Well, that part's also interesting. If we're getting double-digit earnings growth, but yet we're taking jobs off, that almost sounds like automation and advancements in technology could be a part of this answer.
I don't know how much I believe in the double-digit earning growth anymore, because the market's so skewed by certain companies. It's so hard to say, who's really having double-digit growth. Is the mom-and-pop shop down the street having double-digit growth? So that's the question, right? And so I think it's really hard when you have such mega forces out there that are controlling a lot of the numbers and the data and really the feelings of the market. It's tied to people's 401ks, everything. I mean, we're talking about the Magnificent Seven. Yeah, there's lawsuits going on about that now and all that, but still, it still is a driving force, and that makes up the majority.
It sounds like, to be a math nerd for a second, it sounds like we should consider the median as opposed to the mode. But all you math people probably laughed at that one. Ron laughed. Nobody else got it, but gets it. But median, the middle.
I got you, Brian.
The walking calculators over there.
Yeah, you lop off the extremes and you deal with the middle, if you will.
Yeah. No, it's a really good point that Tim makes, because it is like a stratified market. You took the top 20% of companies. Their earnings have been fantastic. The bottom 20% size and probably not the same kind of effect. So that you have to look at if you just look at the measure as a whole, you're looking at everybody and averaging it in, like what you were saying, Brian. So you can't even really just look at it as the mode. You have to look at it by a stratified look and see, okay, which sectors or what size companies are really doing well and which are not. But Tim's point about the jobs thing too was really good. It's that, they're not positioning for growth. When you see the openings scaling back, people are not positioning for growth. They're starting to position more defensively. And that can lead to the other. Now, what that probably leads to at first is higher productivity, because fewer people are doing more work. So that gives us better productivity numbers. But in the end, that really begins to hurt.
Gotcha. Yeah, so that's an interesting point that makes me think about rates, Ron. I know we're here in September, rate cut decision. About everybody and their mother says it's going to happen. Walk us through what the markets are telling us about rate cuts and where you think they're going.
Right. So remember that the Fed has a dual mandate to provide for price stability, which is the inflation side, and full employment, which is the job side. And one thing that I didn't mention on the JOLTS number, the job openings number, is that this is the first time since 2021 that the number of openings is less than the number of unemployed Americans. So it's starting to show, okay, this is getting real. Now there's more unemployed than there are jobs available for them. So the Fed is looking at this, and they're realizing that the weight of their work has to be shifted from fighting inflation to propping up employment, because if employment keeps dropping, then we will be definitely sliding into recession. And so that's what the decision has been. They've been pushing it off as long as they can because they've been afraid of the inflation and the tariff effects, but those really haven't been showing up. And so we're coming to the point they're going to have to start cutting. So the forecast right now is 25 basis points cut, a 0.25% cut in September, and then we'll continue on that path down for about 5 cuts, so about 1.25% lower than we are now. So we're at 4.25% to 4.5% right now. So we're looking at going all the way down to 3%.
Okay.
Somewhere mid to late next year.
So a lot of the people that come to our seminars and that come to meet with us, they're not retired yet, but they're getting to that age where they want to start planning. And my concern that I was asking Ron was, with the risk of the current market, in the event that these companies start saying, hey, you've been here for a long time, we don't have enough job opportunities available, we're going to send you off to retirement early to allow space for other people that are younger and more qualified. Do you feel like that's going to affect retirees?
Yeah, one of the things that forces that decision in the mind of corporate America is which person is less expensive to employ. Mm-hmm. Is it the person that's got 20, 25 years of experience and holds a mid to senior level position, or is it the new hire that's going to come in at the lowest end of the pay scale? And as we get into a tighter and tighter marketplace, that becomes a decision that starts to push things forward, especially as they're trying to maintain their profit margins and keep those double-digit earnings up. Yeah. So, Tim, your economics background is fantastic. You could probably explain this really well.
Yeah, well, I think it goes back to that top-heavy part a little bit too. Like, so if you're top-heavy, you don't really care, and you have those new jobs opening. If you're not top-heavy, what's going to happen is eventually you're going to start losing profits because the people are aging in their job, and they're not going to be able to continue to do it. You're going to have a list of how many people are going to be retiring over a period of time. So you're going to be forced to do it. So in a time where it can be cheaper for you, because if you're top heavy, it's more expensive to the bottom line. In a time where it can be cheaper for you, in a situation where you have less openings, it may make sense to try to usher people out to get new on, because it's going to be the cost, as Ron was talking about. I would say that the cost would be much less to train someone relative to the overall profit, because you're not top heavy. So yeah, I think retirees could be affected 100%.
Especially if you're of the biggest organizations that has the most bandwidth and breadth to do training for those younger people. Because that's the biggest contrary argument. Right. Well, you're going to get rid of all the experience, so the jobs are going to suffer, the final product is going to suffer. Well, quietly, maybe not so quietly in other areas, in areas like ours, but the federal government has done this. In fact, September is the first month of the DRP, the Delayed Retirement Program, where the Fed basically said, we're going to ask a bunch of people to volunteer to retire early that are pension eligible, go on and get out of the workforce, which not a prophet, I don't know what's going to happen next year, but when you don't get enough people to sign up that you expected to sign up for that exit, well, then you're going to have to forcibly retire people.
Right, and that stage one was to volunteer.
Stage one is volunteer. They actually did stage one. I think this is stage 2 or 3 of the volunteerism of, delayed or early retirements, if you will. And they got great packages. I know we've got clients that have been getting paid to be retired as an employee from March until September, and this is actually going to be their quote-unquote final paycheck here as an active employee. So
there's a lot of issues when you are volunteering. There's a lot of benefits of when you are volunteering to leave versus when you are kind of being voluntold. You don't get the same offer.
No doubt about it.
Once they start making the decision of who's staying and who's going.
Sure. Well,
so if you're close to retiring and this is a concern for you, now is the time to start looking at your accounts and planning for the future.
Absolutely.
Well,
definitely the time.
I would argue Corinne's point is, I'm going to argue for Corinne's point that is incredibly valid, because the people who didn't volunteer, but are retirement eligible, those aren't necessarily folks that just love their job and love working for the government. And hopefully this isn't you out there, but it's been my experience that if this sounds a lot like you right now, you might not have planned well for your retirement. There might be uncertainty about what your retirement looks like. There's uncertainty about how this bill is going to get paid. Maybe, a couple of these clients that I'm aware of, they wanted to work a little longer, were planning to work longer to pay off some debts. They got an RV a couple of years ago. They got that new car. I'm going to plan on being debt-free by the time I hit retirement. And then, oh, by the way, the government's forcing me out. Does this mean I'm going to go have to get a second job after the federal government? Maybe it does, maybe it doesn't.
Yeah, maybe if you made those debt choices, then yeah.
But this is where planning comes in. So if let's take a quick break here and just say 757-961-0700. If that sounds a lot like you, if you were a federal employee and you want to volunteer, or you're concerned about getting laid off come next year because they didn't get enough volunteers, now is really the time to plan.
Right.
The old adage of buy low and sell high, with the markets at relative all-time highs, it really is a good time to be rebalancing your portfolio, not only for your risks, but also for your retirement plan. So great segue into how interest rates can affect employment. I know in the beginning, Ron, we wanted to take a slightly different direction here, so we'll make kind of a hard stop and shift over to chatting a little bit more about what we wanted to relative to how this trajectory of interest rates can impact employment. So, pause.
Yes. Well, so so the idea is if you lower interest rates, you'll be able to do other things to free up cash flow, refinance debt, become more profitable. Thus, you can increase employment. Well, yeah, if you lower interest rates, the whole idea is it creates some type of stimulus, which should create profitability. You either refinance debt or you have more cash flow on the table from something, and now you can ultimately hire more.
Now, Ron, does that usher in a new stage of growth then, when you can just start hiring new employees, when you're able to refinance and right-size the balance sheet, so to speak? Is that historically what you've seen?
Yeah, once we get into a situation where we can start growing again, then that's where the new hiring comes into play. When businesses feel comfortable and confident that they're going to be able to continue to sell more and have growth in their margins, then they're willing to go out there and hire new folks and expand.
And I think that's where you're going to see I think that's where you're going to see like the rest of America's businesses, not just your Magnificent Seven.
The small business.
But the small business, the medium business, the mainstream business. That's when you're going to see them become profitable, is when the stimulus comes in and they're able to do things, they're able to lower their debt, increase their profits. They're not sitting on billions and billions of dollars of capital. It's really going to change the way that they can control their flow of business. They can rearrange their infrastructure. They can scale. They can do things they've been wanting to do that they couldn't do.
That's a really good point, because correct me if I'm wrong here, Ron, but didn't the big beautiful bill just throw, starting in January of 2026, so very timely in our rate cut sequence here, didn't they just throw like up to $1 billion of capital expense is now 100% tax deductible?
Yeah, for businesses, right?
Yeah, well, that's what brings jobs.
Yeah, time to buy a building, own it. Yeah,
time to build a building, buy a building, buy new
put
equipment.
in new equipment.
Yep.
Yeah, all those things. Increase productivity.
That marries very well with stimulus, doesn't it?
Well, and what you're calling stimulus, so the listener's clear, is lower rates.
Lower rates, yeah. Lower rates is going to
have a stimulative
It has an effect. Lowering the rate doesn't do anything. It's the effect that happens.
Sure.
So you lower the rate, and then has an effect, and that effect will be a stimulus.
Mm-hmm. Gotcha.
Right. So right now we're in a zone where the interest rates are considered to be too high. They're too high. They're not stimulative.
Right.
So we need to get them down at least to neutral.
Yeah,
so that we can at least be normal, and then move into the stimulative side.
We were kind of asking you earlier.
Yeah,
what is normal?
Yeah, let's unpack.
Right. What is normal? Is it the long-term inflation rate? What is normal? That's the question, and maybe we bring that back on the next segment on what is normal. What is a normal rate? They're lowering the rates. We have the stimulus, but what is normal? Either way, I think that can really create uncertainty in someone's retirement portfolio. They need to know now what they need to be doing. Take the time, review things, get with fiduciary, understand your exit strategies, and maybe like Corinne was saying, maybe now is the time to retire. Go ahead and plan that out. But the key word there is plan. So if you don't have a plan, feel free to give us a call at 757-961-0700. Again, 757-961-0700. And check us out on the web at fitzwilliamsfinancial.com.